In this video, I'm going to go deep into the Fed chairman's speech, the person of Jerome Powell, that happened yesterday during the FOMC meeting. I'm going to play the video for you, you watch, or we watch it together, and then I'm going to tell you future expectation from Fed, in my opinion, in the take and the condition of the markets right now. This is a very important video, so watch gradually all the way to the very end.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5%.
Now, guys, pay attention to that. You see, GDP is growing, which is very important, so pay attention. Let's go.
In the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level.
That's another point to take note of, the unemployment rates. Let's go.
Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
This is the issue with Powell, okay? When inflation was down early this year, around April, May, we were seeing very low inflation. He refused to cut rates as a result to him because of the tariff. But let's see what happened next year, okay?
Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year, and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
These are the two mandates of the Fed. Number one, is to promote employment for the American people, and secondly, to maintain stable prices. That is why the Fed was created. Let's go.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen.
Tariff that they've been shouting that is going to affect the economy drastically remain to be seen, according to Powell. And it's about 5 months plus now that Trump placed those tariffs. So do you think in 6 months to 5 months we should not see the effect of tariff? So it means that Trump and his advisors are correct that the tariff don't have effect on inflation or in the economy. But let's go.
A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this.
Note that statement. The balance of risks have shifted. That means Fed is now shifting their stand towards cutting rates. Let's watch.
This meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance.
Now, that is why incoming data is very, very important. So nobody can rightly say that there will be 50% basic points or there will be another 25% basic point accurately, because you don't know what the CPI data is going to come out to be. You don't know what the GDP data is going to come out to be. What of the PPI data? You don't know what this data is going to come out to be. You don't know what the future holds. However, what Fed is going to do, at least we can say 50% they're going to do this, and the remaining 50% is in the hand of what comes out of those data. Let's keep watching.
Of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
All right, one key thing here is, if you go a little bit further into the question and answer section, which I want us to go into, because some of these questions actually brings out some statements or words from the mouth of Powell that investors use to diversify or to project what Fed is going to do in the future. Okay, it's just like you asking a pressing question and try to know his or her intention. Okay, so this question and answer session is very important. So keep watching.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you, you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time.
All right, guys, I want us to go to a wrap-up of Powell's speech, then we'll continue with this question and answer very quickly. So if you come right here, one of the things I discovered from this very speech, that is the FOMC, the takeaway first is what I want to talk about right now. So it is that inflation has picked up, but not as bad as expected because of the tariff that President Trump placed on certain countries, especially some countries have a lot, some countries don't. They expect inflation to rise drastically. But what we saw was decreased inflation, first of all, and then for the past 2 to 3 months, that is August and July and June, we've seen inflation begin to rise a little bit upward, especially the month-on-month inflation. However, the year-on-year inflation is also rising a little bit. And if you remember what Powell said, he said that their inflation goal is 2%. That is, bring inflation back down to 2%. However, the beginning of this year, around February, March, April, we see inflation approaching 2.2, 2.3% year on year, okay? And that of month on month was 0.1, 0.2 or thereabout, but they did not cut rates, okay, because of the tariffs. Now, another thing that is very important is that maximum employment, okay, but not gaining momentum as expected. This is very important because this also means that unemployment is gathering momentum. So they expect unemployment to decrease while employment increase. If you look at the job numbers for the past 3 months, you discover that it has been coming back down. However, the federal government is not really hiring. We're looking at private sector jobs, very important. And if you look at unemployment, remains low as expected. So these are the takeaway, first of all, when it comes to these two goals that the Fed have. Number one is to maintain stable prices for the American people, and secondly is for maximum employment. So if there is maximum employment, it means that it is going to reduce unemployment. So this is very, very important. So let's look at future expectation, which one of the things I want you to really pay attention to, because this is what investors use to project what they think Fed is going to do in the future. Because during that question and answer, you begin to see Fed say something that he never said when he was just making the speech. So we have medium projection shows additional 50 basic points this year, at least 25 basic point cut in 2025. So that is the expectation. Now, for me, I am a little bit sure that Fed is going to cut rate by another 25 basic points. And the next Fed meeting, if my memory serves me right, is in October 29th, if not 28th, between 29 or 28, except they change it. But from when I checked, it was October 29th. That is the next Fed meeting. That is the next interest rate decision and FOMC meeting. And then the next one will be in December 10th. So it can be that in October, they're going to cut another 25%, and then in December, they will leave it unchanged. Or they will cut 25% in October and cut again in December. Remember, in November, there is no interest rate decision, no FOMC meeting. So this is the media projection, okay, future projection and what you should be expecting from Fed. So if investors are now thinking about, okay, Fed have possibility of cutting another 25% basic points in the near future, what do you think investors are going to do? Definitely, people are going to position, because if Fed begin to lower interest rate, it means that banks can begin to borrow at a lower interest and also lend to their customers at a very lower interest. And this is why investing is very, very important. And when you understand these things and begin to dissect into what Fed is going to do in the future, it puts you at a better stand to make the right decision. So for me, Bitcoin is going to move upward, okay? Even though we don't see crazy aggressive move to the upside, definitely we're going to see significant bullish move all the way to the upside. Another takeaway is that Governor Miriam, the dissent in favor of 50 basic point cut, and that did not take place. And then we have 6 Fed officials see no rate cut in 2025. This is very important. 6 Fed officials see no rate cut in 2025. But good news here is that 9 Fed officials see additional rate cut in 2025. And of course, if they are doing voting and majority should carry the vote, and majority should carry the case, and majority should win the case, that means if 9 vote for more rate cut, maybe 25% basic point, then it means that this is going to absolutely go through and we're going to see a rate cut. So there's a high possibility of them cutting rate by another 25% basic points this very year. Then next is that the Fed is shifting their focus to the labor market. So they are now shifting their focus to employment, okay, and unemployment. This is very, very important. So for the fact that employment is not really gaining momentum as expected, if we cut rates, we believe people are going to hire, and all of those stuff is very, very important, and more reason why they want to cut rates. So shifting their focus from tariff. So for the past 6 months and more, we've not really seen the impact of the tariff on inflation, okay? So since we don't really see that, there is still risks, okay, but let's shift our focus to the labor market and try to do something so as to ensure that the labor market gain momentum. That is what the Fed is doing right now. So this is very important takeaway that you must not have to neglect in this very video. So let's proceed with the video.
Time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I think a follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation viewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on, so that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months, and it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation.
Let me point out something on the price action. Okay, on BTCUSDT price chart, it is covered that after the FOMC meeting yesterday, it is covered that the markets come back down. I talk about this in on the Telegram channel that we should expect a very little dump, not aggressive before the pump. And that was very important, and the exact same thing we see right here, market dump a little bit, okay, and then market pump. Very importantly, so what I'm expecting is that, you see, before the FOMC meeting and the interest rate decision, you discover that the market is already priced in, okay. And of course, when market pricing this much prior to the rate release and the FOMC meeting, we see the markets tend to go back down before the next move to the upside. And that is why I'll be talking about the fact that even though we see Bitcoin come back down, that move for me is not going to be sustained. It's not going to last long. We're going to see a quick flip all the way to the upside, because from our projection is that Fed is going to cut more rates, at least 25 basic points this year addition. Some person are expecting 50, okay? Maybe 25 or 50 at a stretch. However, what I'm expecting is for the market to move upward. And if we see the market come back down, which I'm going to look at what the market do into the weekend, market is going to still move all the way to the upside. This is what you need to pay attention to right now, moving forward on the price of BTCUSDT. And if you've not joined this channel, I believe you are missing out greatly, because I'm going to be dropping the altcoin you should be buying for this very season, both meme token, layer 1, layer 2 crypto. All of these I'll be dropping on this very channel. So if you've not joined, join right now. Link in the description of this very video and also in the pinned comment. It is a free channel. Join right now. And many more updates like technical analysis and signal will be dropped right here. Look at technical analysis right here, and many more updates. And one other thing very important I always tell people is that, you see, sentiment about the market from communities are very important, especially in the bull market. So this is one of the community you can consider joining. The Remit community is going to help you greatly. Link below. Join right now. Consider supporting this channel by leaving a like for this video, subscribe if you haven't already, and turn on the bell notification for more crypto videos like this one. Also check the channel for other crypto content. Thanks for watching, and I will see you in the next video.